All right, if you're an investor, you are going to want to listen up. There was a huge announcement in the recent budget that completely flipped a major tax rule on share buybacks. And believe me, the change is fantastic for shareholders. Let's break down exactly what this means for you. And I'm not kidding. If you own any stocks or you're even thinking about getting into the market, what we're about to cover could directly impact your wallet. This is a really big deal. So what is all this buzz about? Well, you know that really unpopular, kind of crazy tax rule from 2024 that penalized investors? It's gone. It's been reversed. And this is a massive win, especially for all the individual retail investors out there. Okay, so to really appreciate how good this change is, we first have to understand the villain of our story, that really painful tax rule that came into play after October 2024. So here was the core problem. Under that old rule, when a company bought back your shares, the entire chunk of money they paid you was treated as dividend income. This meant the whole amount was taxable, not just the profit you actually made. Let me give you an example, because this is where it gets wild. Let's say you bought 1,000 shares at 300 rupees a pop. Later, the company offers a buyback at 500. Great, right? Your total proceeds are 5 lakh rupees. But under that old rule, your taxable income wasn't your profit. It was the full 5 lakh rupees, the whole thing. So if you were in the 30% tax bracket, you'd owe a staggering 1,50,000 rupees in tax. Think about that. A tax of 1.5 lakh on a profit that was only 2 lakh to begin with. It just made no sense. Oh, and it gets worse. That original 3 lakh rupees you invested, the government then treated that as a capital loss, which meant you then had to go find some future capital gains just to balance it out. I mean, what a headache. It was a super complicated and impractical process for any normal investor. You know, this rule was so bad that it basically put a freeze on the market. After it came in, pretty much no major company, with Infosys being a rare exception, even bothered to announce a buyback. It was a terrible deal for investors and companies alike. But now, let's talk about the good part. Let's talk about the hero of the story, the new common sense solution that was announced in Budget 2026. The new rule is just simple and fair. It's what it should have been all along. Buybacks are back to being treated as capital gains. And that means exactly what you think it means. Only your actual profit gets taxed. I mean, this side-by-side comparison says it all. We've gone from a crazy system that taxed the entire amount you received to a logical one that only taxes your profit. You know, the buyback price minus what you paid. Simple, fair, done. So, what does this actually mean for your bank account? Let's go back to our example and see the real-world difference this change makes. Wow, just look at the difference on this chart. It is absolutely staggering. On the left, you've got that huge massive tax of 1,50,000 under the old rule, and there on the right, the new tax is just tiny in comparison. It's an incredible and very welcome change. So let's run the numbers one more time, but with the new sensible rule. You buy at 300, they buy back at 500. Your profit is 200 rupees a share, so 2 lakh rupees total. And now, under the new rule, that 2 lakh profit is the only thing that's considered taxable income. So, what's the new tax bill? Get this. If you held those shares for over a year, making it a long-term capital gain, your tax would be just 9,375 rupees. That is a massive, massive saving compared to the 1,50,000 before. What a better deal for investors. Okay, so we get it. The change is a huge win. But what about the nitty-gritty? Let's get into the practical details, like the exact tax rates and the key dates you really need to keep in mind. All right, the rates are pretty straightforward. For listed shares that you've held long-term, it's 12.5%. If it's a short-term gain on those shares, it's 20%. And for any unlisted shares, the tax is just based on your personal income tax slab rate. Simple. And here's the timeline, just so it's all clear. The problematic rule kicked in back in October 2024. The great news of the change was announced in February 2026. And, most importantly, the new, better rule officially starts on April 1st, 2026. So let's just quickly sum up why this is such a big deal for you. First, your tax bill on any buybacks is going to be way, way lower. Second, you can actually deduct what you paid for the shares in the first place. Third, we should see companies being much more open to announcing buybacks again, which finally leads to a fairer, healthier market for everyone. At the end of the day, this is just a clear, logical, and really investor-friendly fix to a major problem. It brings common sense and fairness back into the system. So the only question left is for you. Are you happy with this change? Let us know what you think.